Hey, welcome back, everyone. It's John. It's time for a general market update. It's February 23rd. I'm recording this about 7:30 p.m. Eastern Standard Time. Just a reminder, I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So here's our agenda. It was a volatile week. We're going to look at the indices, and we're going to look at some of the market internals, with particularly looking at what's happening each week, week-to-week changes. Then we're going to look at the leaders. It's always important to look at the leaders, and then we're going to try and wrap up. So into the market itself and some of the internals. This is the S&P 500. This is a daily chart. So what I'm trying to show on the chart here is we've had some gaps down, we've had some gap ups, and there's a little bit of distribution happening in the index. You can see I've marked 3 distribution days within a 25-day period on the S&P. We've been flirting around with the 5,000 psychological level, which we expected. It still would not be unusual to have the market come down and consolidate some of these gains that we took off from November. A 5% pullback would bring us right down to the 50-day or the 10-week moving average, which would be normal to come back to that zone. One of the things that has me a little concerned about the S&P is this, what I call a bad up day. And this was on Thursday, yesterday. What I mean by a bad up day is when I think the S&P was up 2%. And usually when you look at the advanced decline line in the S&P, an S&P up 2%, I would expect the breadth to be at least 3-to-1 or 4-to-1 advancers over decliners, and it was nowhere near that. And that's what I call a bad up day. And it was really masked by all the hoopla around NVIDIA. Got all the news attention, but it's a subtle sign that under the surface, things are not falling gear. So here's a little insight of the NASDAQ. I believe I pulled this as the Qs. Again, just looking at some of the distribution that we've been getting in this last push up, you can see here that marked about 5 distribution days in the last 25 days in the NASDAQ. And in particularly, there's been 3 distribution days in the last 8 days of trading. When you start to get clustering, usually 4 within 8 days is what I'd call some clustering. We're getting close. So it's a rolling 8-day window. So hopefully we can shake off, and a couple of these distribution days will come off after 25 trading days. So again, distribution has created some volatility in the markets. So what's this all about? We had the CPI day a couple of weeks ago, and if you look back at the Fed probabilities and rate hike cycles from the Fed Watch tool at the CME site, in mid-January, the prediction was there was odds of a rate cut that was going to come in March. It was 46% was looking for a cut, expecting a cut. Well, we didn't get that, and we had the hard CPI information that the market's been readjusting to when the cuts might come, and all the different financial modeling that goes around that. On February 21st, this week, now the rate cut odds using the Fed tool say that a cut, 72% say there's going to be a cut coming in June. So a couple people, the group consensus is saying quarter point cut. Others are saying maybe a half a point cut. So all of this is creating volatility, readjustment, as I mentioned, in the markets, which is creating some of this distribution as money is starting to rotate around in the markets. And we've seen actually bond yields start to rise again. So I'll explain this chart. I've actually pulled this chart showing an overlay of a number of things, so I'll walk you through it. The black is the NASDAQ composite on a daily line chart. At the top here in the teal color is actually the percent of NASDAQ stocks above their 50-day moving average. The purple line is actually the US dollar. And then I've shown new highs, new lows. So when you start to line these up and really looking at what's been happening in the market, we had this follow through day, and we had this great rally, a push for almost a good 7 to 8 weeks. The percentage of NASDAQ stocks above the 50-day actually peaked on December 28th at around 74%, which is really good. That's a characteristic of a bull market. But you'll notice that that has been declining gradually ever since the start of the year. We only have about 49% currently above the 50-day, which is not great. Not horrible, but not great. And the trend is more of the issue. And don't forget, this is happening when the NASDAQ keeps rising as an index, really primarily driven by the Qs and some of the weightings, and you're getting a little bit of divergence of breadth with the index. Now, I put the dollar on here because you'll notice that the US dollar, this whole rally of the follow-through day was based on yields, coming down. Rates going to be anticipated to be coming down in rate cuts. So the US dollar actually bottomed right when we saw this peak. And you'll notice that since it bottomed, the US dollar has been rising. And usually that's not a great sign for stocks. And I've tried to line up. When you look at these little points where the dollar actually spiked higher here, here, and here, and if you line them up with what was going on in the NASDAQ, you can see that these sharp little corrections that we've seen, the volatility, 1, 2, 3, that we've seen in the NASDAQ. And some stocks are getting hit. Some of the leaders are getting hit on earnings reports and what they're saying about their future guidance. So there seems to be some correlation between the dollar, yields. Obviously, it affects growth stocks. So the market's been readjusting, and there's a lot of different opinions about that. But we just want to really look at price, but we want to be aware of some of these internals. The other thing that was I don't like to see is right off these peaks. You can see here, this last peak we actually had net new lows show up in the NASDAQ. We don't want to see net new lows right off the top. That's not good action. Usually what happens is the market pulls down, the net new highs will decline, but you don't get to two net new lows, usually until the correction or the pullback is near the end. And then the market will pull out of it and rally. Now, to see that off the top is another clue that to get to net new lows right off the top tells you that under the surface, there's this deterioration with less stocks above their 50-day and some in cases they're below their 200-day. So just something I'm using to keep watching the action. Has me cautious on the market right now. So let's look at the action of the leaders. It is very important to do every day and certainly every week. So here's my little table that I use. This is as of last week's table, and I just pasted it in. And then I've updated it as of last night. So just doing the squint test, last week we had a number of stocks. I put them in green because they had 3 or 4 really strong green characteristics. And you can see that it was, I don't know, maybe 2/3 of the list. Using the squint test, you can see there's been deterioration. There's less stocks with, I'll say, 3 or 4 green characteristics, probably shifted a bit. And you can see here that it's less. And you'll also notice that a number of stocks are coming off their highs, and some of them are coming off their highs quite a bit, 15, 20, 30%. And you can see some of the pink coloring. These are where ratings are starting to deteriorate. So there's been some deterioration in the leaders, even though some of the pullbacks are revealing some of the really strong leaders in the market, the NVIDIAs, AMD, Nutanix. So there's been Uber's been really strong. So there's been some deterioration, just something to keep in mind. Not a disaster yet, but it's definitely some of the stocks that we thought were leaders are not holding up their weight. Shopify had better earnings. Fresh has deteriorated. Affirm, and certainly everybody knows about PanW. The earnings report was a good report, but the guidance was not what Wall Street wanted, and they really punished the stock. So I want to look at one of the leading groups since this rally started in November, and that's cybersecurity. So this is the ETF hack for cybersecurity. Been a really strong move. You can see basically the 20-day has contained almost the entire move. Now, we had this really sharp break off the top. And, the PanW earnings, we had this violent shakeout below the 20 and the 50-day down to kind of the support level here. So that would, it looks like, is that a shakeout? We've had a rebound the past 2 days. We gapped up. We actually had an open equals low candle. So the volume is a little bit questionable. It's going to be really important to watch this. Is this a shakeout? Or another way to interpret the chart is showing, is this the beginning of a head and shoulders top in cybersecurity? You can see this could be the left shoulder, this could be the head, and we had this hard break. And you can see here that, we broke this low here, so we've had a hard break to create some damage. This rally is pretty important. We're coming right into the 20-day. The volume is a little bit light. It's going to be really interesting to see if this actually pushes and maybe bases. That'd be constructive. But if it rolls over quickly, we may have a head and shoulders. So be flexible. We want to be open to both sides because this is a leading group. So looking deeper into the group, as I mentioned, I wanted to look at 3 of these stocks. We're going to look at Palo Alto, look at Zscaler, and we'll look at Crowd. So just looking simply at a daily chart, PAN-W got knocked down. It basically came all the way back down to its 200-day moving average. Little rally the past 2 days. Now look at Zscaler. Zscaler got whacked on the same day as the PAN-W earnings, but you'll see that it actually came down between the 50-day and the 200-day. Not as deep, but obviously a very sharp, deep gap down. Now look at CrowdStrike. CrowdStrike gapped down and actually grabbed the 50-day moving average. Came all the way down below it, got support, and closed basically on it on Wednesday. And then the last 2 days we saw it gap up on the NVIDIA report, and today was fairly quiet. So when you're looking at the leadership of the group, so far this action is showing that CrowdStrike is actually the strongest of the 3 stocks. And I will disclose, I have a position in CrowdStrike that I've had close to the follow-through date. So that's where those stocks are. Now it's interesting because looking at the hack ETF, I have to wonder, say, is there bad news or more bad guidance coming from the group? Zscaler is going to report on February 29th, next week. And CrowdStrike reports, I believe it's March the 5th. So we're going to see, it's going to be really interesting to see what Zscaler has to say, and eventually CrowdStrike. Is this something, is the Palo Alto report, and more importantly, their guidance, is that representative of the group and the industry, or is that just a one-off to that particular company? So certainly this action gapping down is not good, and it gets everybody kind of freaked out. So the question is, if you're a position trader, is it time to panic? I would definitely say no. You should be using your sell rules. If your sell rules are triggered, you must, use your sells. Now, what's important, I think, is, again, a position trader that may have a position, you want to look at weekly charts, and you also want to look at the 10-week moving average. Every big leading stock pulls into the 10-week moving average at some point. So let's look at this a little closer. So I've pulled up Adobe, and this is a big winner. It's in my 55 greatest winners book, but I pull it up because I put this notation is because I really studied 10-week rules and 10-week moving average breaks. And Bill O'Neill, if you follow some of his notations in How to Make Money in Stocks, he notes that the first week of a 10-week moving average break is the one that's really pretty important to give you a read on how strong the stock is and if it's really getting institutional support or not. Probably the first and second trips to the 10-week moving average really give you a lot of clues and information. Now, you have to have good sell rules for how you use the 10-week moving average. When I release my website, I will have a whole probably hour and a half video just about my rules using the 10-week moving average, and I'll explain it all. But the point I wanted to make is here's where in early 2017, Adobe breaks out. And you can see there are times where we touch the 10-week moving average. Sometimes we broke and closed below the 10-week moving average. And I looked at these, and using my rules, you can see the gray ones are situations where it's telling me don't sell, don't sell that 10-week moving average break. And other areas where you'll see in red where it says, yes, this triggered the sell signal, and you would have to exit the stock and at least reduce your position. And you can see I followed it all the way through the run. So the 10-week moving average is important, particularly these first 1, 2, here's 3 trips. And if you freaked out and got shaken out of the position, you missed this really big run. So if you're trying to catch a model book stock and you're trying to hold it, we know they always come back into the 10-week at some point. So and the reason I'm showing this is because as bad as Zscaler and CrowdStrike got hit in the Palo Alto news, if you look at a weekly chart of Zscaler, it got support and closed above the 10-week moving average. Same thing for CrowdStrike. It's a big long tail on the bar, and the weekly bar shows that it got support on big volume and closed above the 10-week. That's telling you that those two stocks are getting institutional support, at least at this time. Now, the earnings reports might reveal more. We got to be flexible, but right now they're holding in there. So let's get to the summary. Now, we follow our routine each week, and we'll talk about routines when I release my website, but you want to follow your routines. You want to analyze the trend. You want to analyze the action of the leaders, and you need to know what to look for. Obviously, it depends on your time frame. If you're a position trader, you have some things to look for. If you're a swing trader, you might have some other things to help you with trend and the action of leaders. And certainly if you're day trading, you've got a whole different system and methodology. So we want to take the feedback and listen to the market. Some things are very mixed and a little hard to read right now. So we have to be flexible. It was a very volatile week. We had the Palo Alto gap down. We had the super NVIDIA earnings report and gap up. So it's been very, very tricky through earnings season. Trading stocks, it's kind of a little bit like a Texas Hold'em poker game. As cards get dealt on the table, you have to react to them. So every new card the market deals you is more information, and you make your decisions on the cards in front of you. In our case, we're looking at charts. We're looking at chart action and the behavior of the stocks to make decisions, and hopefully the best decisions we can. So remember also, when you're trading, you can always change your bet. So if for some reason you're not comfortable, you're afraid, you're fearful, you can always reduce your position size to get to a comfort level of your position. You can change that bet at any time. If you have sell rules, you might get pushed out of the market. It's been a really challenging market. I only have 2 positions remaining right now. I have CrowdStrike and AMD. I was knocked out with small paper cuts and 4 other positions, but that's just part of the game. When you have these violent shakeouts, if you don't have cushion, you're probably going to have stops being hit. That's normal. That's part of the game. You just don't want to take any devastating losses. And that's why you have to have sell rules and keep your losses small. So let's try to wrap it up. The NASDAQ has a little bit of a cluster of some distribution days. Want to watch that carefully. I definitely want to watch the S&P's breadth carefully after that bad update. But in general, key levels of support are still holding. We had a dip below the 20-day on the NASDAQ, but we recovered it really quickly. And remember, the power trend is still up in place. We still have the 20-day above the 50-day. So on the net new highs, new lows front, the one thing has me a little bit concerned is when you're getting these coming off the highs and getting net new lows to reappear. That's showing us weakness under the hood. That has me a little bit cautious. Leaders, some of the leaders have still remained very strong, even amidst the volatility. Some have gotten hit. Some have taken on some water, as I showed in that little color graphic. Now, position traders, if you have cushion in a stock and you're trying to play it out for a big move, then you can need to be keying in on the 10-week moving average. You want to have your sell rules, and hopefully you can withstand a stock that builds a base or bounces off the 10-week. Exposure levels, I think, should be reduced. I think naturally we're getting knocked out of some positions, so we're reducing our exposure. What's important is just because you've gotten your exposure reduced by being sold out of position doesn't mean you have to keep opening positions. The market environment is very tricky right now, and you don't have to just keep putting on exposure. The market is telling us that things are a little bit mixed. Strong leadership from stocks like NVIDIA are great. If you're in there, you're in a good position. But I think the I think the exposure is reduced a bit. I use the 35 to 45% level, but it all depends on your risk tolerance and how aggressive you are. So the quote of the week is from Mike Tyson. Everyone has a plan until they get punched in the face. The past 2 weeks, we've had a couple of shock days to the market, CPI day. Palo Alto dragged down cybersecurity in a big way this week. So there's volatility. Hopefully, you're creating a plan every night of how you're going to handle the market offensively and how you're going to handle the market with a defensive plan. And it's important. Once you're in the heat of battle, follow the plan. As Mike Tyson says, once you get punched in the face, you can't let emotions just take over and have you freaking out and doing things that really are harmful to your account. So stay with a plan and put a plan in place. That's the general market update for February 23rd. Enjoy the weekend, everybody. We'll see you all next week.